I greet you, ladies and gentlemen, as I come before you to do part 2 of the topic that I started in a lecture which has already been posted to YouTube. We are still looking at foreign exchange market dynamics. I will share my screen. I'm still going to post a video where I'm going to be sharing on the annualized forward premium and also the annualized forward discount. I'm going to do a separate video to cover these concepts, which I promised to cover in part 2 of this topic on foreign exchange market dynamics. So when we are looking at interest rate parity, it's a very important concept in foreign exchange trading. I can safely say the interest rate parity is a very important concept in international finance in general. It is a fundamental equation that governs the relationship between interest rates and currency exchange rates. The fundamental premise of interest rate parity is that hedged returns from investing in different currencies should be the same, regardless of the level of their interest rates. Interest rate parity is a concept that links Forex market rate and the country's interest rates, and states that if the currencies are in equilibrium, one cannot make use of the opportunity to make profits just by exchanging money. So there is no room for arbitrage. The underlying concept is that returns from investing in various currencies must be independent of the country's interest rates. Hence, there will be no arbitrage opportunity in the foreign exchange markets, which simply implies that investors cannot seek to profit by the difference between interest rates using foreign exchange as an asset or a way to invest. So if interest rate parity holds, there's no opportunity to make arbitrage profits in foreign exchange markets. Put simply in layman's terms, the concept of interest rate parity implies that any foreign exchange market player cannot make a riskless gain using foreign exchange as an asset or a way to invest. There are two versions of this concept of interest rate parity. The first version is the uncovered interest rate parity. And then we've got the covered interest rate parity. The uncovered interest rate parity concept is also sometimes called the naked interest rate parity. And then we've got the covered interest rate parity. When we are looking at the covered interest rate parity condition, the relationship between interest rates and spot and forward currency values of two countries are in equilibrium. Thus, we assume that no opportunity exists for arbitrage using forward contracts. So there is no opportunity to make riskless profits by merely trading in currencies or by establishing forward rate agreements on the basis of those currencies. In contrast, when you are looking at the naked or the uncovered interest rate parity, it exists in a scenario when there are no covenants. pertaining to the forward interest rate, and the parrot is dependent only on the expected spot rate. So with the uncovered interest rate parity theory, the difference in interest rates between two countries will equal the relative change in currency foreign exchange market. Foreign exchange rates over the same period. It is, and then when we are looking at covered interest rate covered interest rate parity, it's akin to, or it's linked to covered interest rate arbitrage, which is an arbitrage trading strategy where an investor capitalizes on the interest rate differential between two countries by using a forward contract to cover or eliminate exposure to exchange rate risk. So with the covered interest rate arbitrage, it is a trading strategy where an investor or a speculant capitalizes on the interest rate differential between two countries, the domestic economy and the foreign economy, by using a forward contract to cover or eliminate exposure to exchange rate risk. Now, when we are looking at speculation, I'm quite sure that in the literature or in the media, we've met several times the term speculator. The term speculation in finance refers to the purchase or sale of an asset with the view to resell or repurchase that asset on a later date. The expectation is to gain from future change in price relative to the ruling price, and not a gain from its use or transfer between markets. So the idea of speculation is to gain from price movement, not necessarily from the utility, the use or the transfer of that particular asset between markets. When you are looking at speculators, they assume exchange rate risk, expecting a profit. So speculators assume risk. They assume risk. They shoulder risk. And the particular form of risk which they normally bear or they shoulder is exchange rate risk. So one expecting an increase in the price of an asset will buy and hold it. This person is called a bull. There is a time when we are looking at the stock market, when it is said to be experiencing a bull run, the stock market will be experiencing a bull run when the stock market index is experiencing a sustained increase. When the stock market index is experiencing a sustained increase within a reasonable period of time, say a week or 2 weeks, or even just a few days, we say the stock market is experiencing a bull run, or the stock index is experiencing a bull run. So, but there are some foreign exchange market players or speculators who invest expecting a decrease in the price of an asset. One expecting a decrease in the price of an asset will sell it, whilst a person who expects the price of an asset to increase will buy and hold it. The idea of buying and holding, if one is a bull, is to buy something at a lower price. And then the market experiences a bull run, and then you sell at a higher price to make profits which are equivalent to the difference between the two prices, or the price differentials multiplied by the volume of the asset that you are actually holding. But when you are looking at a pair, it's someone expecting a price to decrease. So these people are more given to selling the asset. They would rather offload the asset in order to prevent exposure to foreign exchange risk. If R1 is the expected future rate and small r is the spot rate or the current exchange rate, a pool expects the expected future rate to be greater than the current spot rate. And as a result, a pool will buy the asset now. That is, take a long position with the hope of offloading the asset at a later time when the price actually increases. In contrast, a pair, and a pair is another type of speculant in stock markets or in foreign exchange markets. We expect a pair is associated with a scenario where the expected future rate is lower than the spot rate or the current exchange rate. As a result, the pair takes a short position, which simply means they sell the asset now. They sell the asset now, netting the gain, and in order to buy the asset when it is now cheap. Because the pair banks on the price of an asset going down. Or if it is the exchange rate, a pair banks on the exchange rate value nominal terms actually going down. What does it mean? It means less volumes of the domestic currency traded vis-a-vis a unit of the foreign currency. I'll give you an illustration. Let us assume you have got a foreign currency denominated financial asset. And the foreign exchange market is such that we are looking at the exchange of the United States dollar and the South African rand. A pair would behave this way. If the spot rate is 1:15, and then the expected future rate is 1:13. Obviously, 1:15 is greater than 1:13 in nominal terms. That is, we know that when you are moving from 1:15 to 1:13, the rand is firming or appreciating, but the US dollar is depreciating. So what the pair will do, the pair is going to sell an asset which is denominated in terms of foreign currency at the present moment. They will sell the asset so that they net in when the exchange rate is 1:15, because this is a foreign currency denominated asset. It's a US dollar denominated asset. So they net in the gain at 1:15, expecting the market to go down because that's the expectation of a pair. And then if the market, the index, maybe the industrial index or the stock market index actually goes down, it means the pair or the speculate of this type called the pair is going to then buy the asset when it is cheaper, the foreign currency denominated asset, when the rate is now 1:13. In other words, vis-a-vis the domestic currency, you will be now sacrificing fewer rands, 13 rands per a United States dollar, in order to acquire that same foreign currency denominated asset. So you sell the asset when it is expensive, you buy it when it is cheap. It's called taking a short position. Whilst when you are looking at the situation with the pool will be facing a situation where the expected future rate is greater than the current spot rate. So the pool is banking on the market index firming, or the exchange rate depreciating in terms of the local currency. So if we started at 1:15, the pool will be participating in foreign exchange markets, or in money markets or financial markets of assets which are foreign currency denominated, with a view that the exchange rate will depreciate, because when the rate is increasing from 1:15 to 1:17, the domestic currency is actually depreciating in terms of value. So the pool will buy the asset now. If the exchange rate actually depreciates or it increases in nominal terms from 1:15 to 1:17, it means the pool, which is a type of an optimistic speculator, or who is a type of an optimistic speculator, will be able to sell the asset when its price has risen in terms of the domestic currency, and they will be able to make riskless profits. Realize that I'm actually assuming that the rate of inflation is actually lower, most probably, than the differential between the two interest rates. I mean the two exchange rate scenarios that I've given you. So, as I've already said, when you are looking at arbitrage, the role of speculators, the bulls and the bears, will be already located in the market, not only of currencies, but also currency derivatives as well, which is why I was talking about assets which are foreign currency denominated. What I didn't elaborate is that those assets can be actually futures or options, or in short, they can be currency derivatives. So when we are looking at currency derivatives, these are instruments that are used in foreign exchange markets to manage risk. Standard instruments are traded in organized exchanges like the Chicago Board of Options Exchange, or the London International Financial Futures Exchange, LIF, or the Marsh Term International Finance, MATIF, in the case of France. They are also traded outside the exchanges, that is over the counter, in over-the-counter markets. The over-the-counter exchanges involves banks and other institutions that make contracts that are tailor-made to the needs of the parties, like when a company is making a first issue of, say, shares or particular financial instruments or bonds, a special issue of bonds, because that special issue of bonds is not standardized. It will be traded over the counter. Major instruments are futures, swaps, and options. We've got futures, options, and swaps. When you are looking at futures, I know you already know this, but I'm actually delivering this lecture as a way of revision, in case some have forgotten this concept. A currency futures contract is an agreement between two counterparties to exchange specified amounts of two currencies on a given date in future at an exchange rate predetermined at the time of the contract. If you look at the definition, it's akin to that of a forward, but the important differences are as follows. When you are looking at forwards or forward contracts, the first fundamental difference is that a forward contract can be of any amount, but futures contracts have to be of standard amounts. The second point is that forward contracts are normally traded over the counter. They are over-the-counter instruments, which are directly exchanged between parties. Whereas when we are looking at futures, they are traded in organized exchanges. They are not particularly tailor-made, or they are not tailor-made for specific counterparties in foreign exchange markets. And then number three, forwards have counterparty risks. But when you are looking at futures, futures have no such risk. Payment is guaranteed by exchanges. So that's why futures are used to, in order to hedge, to eliminate the risk, because they are not associated with any risk. Payment is guaranteed by the exchanges. The fourth point is that forwards are illiquid as sets. They cannot be transferred to another person, whilst futures can be freely bought or sold in the market because they are sold in organized exchanges. And then the fifth difference is that when you are looking at forward contracts, they cover around 50 currencies. Futures are only in terms of major currencies, such as the Japanese yen, the United States dollar, the Great British pound, the European Union euro, the Canadian dollar, the Australian dollar, the peso, and so on. The futures, they are only structured for major currencies, not smaller currencies or weak currencies. Now, when you are looking at a future or futures, this is an asset to be delivered in fulfillment of the contract. The asset to be delivered in fulfillment of the contract is called the underlying. In most futures contracts, as physical delivery is difficult, so reversing of the trade. So the contract is ended before maturity. So you invest in this future as a way of managing risk. So you buy this financial instrument in order to guarantee the delivery of the underlying at a specific date. When you are looking at options, options give its buyer the right, but not an obligation to buy or sell a currency in future at a predetermined price or exchange rate. So when you are looking at options, the buyer has got the right, but not an obligation to buy or sell. So it's also a hedging technique, but it doesn't bind the person who possesses that asset or who possesses that derivative. That person is not bound to execute the trade in the future, but they'll be having the right, if they so deem necessary, when they analyze risk or when they analyze their situation or their position, especially in terms of liquidity or in terms of their other obligations, they might decide to buy or sell a currency in the future. Options, they tend to be more complicated than forwards and futures. The seller of an option is called an option writer, and the buyer of an option is called an option holder. So one side of the market, the supply side of the market, it's option writers or the option right. And the demand side of the market is the option holder. We have got two types of options, which are covered in detail when you are doing a cost and risk management. And this is just monetary economics, where we look at foreign currency exchange market dynamics. So we don't go into details like we go all the way to the Black-Scholes model. We don't do that. So when you are looking at options, we have got two types of options. We have got the put option, which gives its holder the right to sell, whilst the call option gives its holder the right to buy. So if I want to buy a currency in the future, I may purchase a a call option. But if I want to sell a currency in the future, I may acquire a put option so that I'm in a position to sell a particular currency in the future. The underlying currency, it's a currency in which the option is given, say the United States dollar or the euro, depending on one's obligations in the future in terms of international trade, because these financial instruments are normally purchased by international traders as a way of managing risk. By international traders, I'm referring to exporters and importers. Exporters and importers, from time to time, they are exposed to different kinds of risk, and especially exchange rate risk or exchange risk. So in order to deal with that, they would normally want their situation to be guaranteed in terms of liquidity in a particular currency so that they can settle their obligations in the future. So the counter currency is the currency in which price is paid. The strike or excise price is the price at which the deal is struck in the future. But remember that with options, you have got the right but not the obligation to execute a sale in the future. The option premium is the price paid by the writer to a holder. Remember, the writer of an option is a supplier of these options in the currency derivatives markets, and the holder is the demand. The maturity to expiry date is the date of expiry of the contract. If the contract expires without being exercised, then the option elapses. It will no longer be actually of no effect to anyone. It means its use no longer exists. And then we have got with options, we've got American options and European options. In addition to the nomenclature of put and call options. With American options, the right can be exercised anytime till maturity. Whereas with European options, the right can only be exercised on the maturity date. So the major difference between an American option and the European option is that with a European option, you can only exercise the option on a pre-arranged maturity date. Whereas with the American option, you've got a right to exercise anytime till maturity. A flexible instrument fixes the maximum payable price and allows one to take advantage of changes in the exchange rates. An option holder can decide not to exercise the right if future sports rate are favorable to them. Say they are required to pay for certain goods in international markets in terms of Forex, and the domestic currency appreciates. It means with fewer units or with less volumes of the domestic currency, they'll be able to purchase more of the foreign currency. So when the domestic currency is firm, a person can decide to just go on the spot market to purchase the foreign currency to settle their obligation to their counterparties in international trade if they are paying for goods and services, or if they are required to extinguish a certain contract that they would have entered into at a certain date in the past. But if spot rates in the future deteriorate, say their obligation was to pay 100,000 US dollars. At the date when they entered into that contract, the exchange rate was 1:13 versus the 1 USD is to 13 rands. And then the rand depreciates. If they try to buy the US dollar in the spot market, if the rate in the future, if the future spot rate is 1:17, it's obvious that they will spend more rands since their domestic economy is the South African economy. They will spend more rands trying to pay $100,000, ceteris paribus. So such an international trader, to avoid exchange rate risk of these losses associated with currency movements, would rather exercise an option which has more favorable terms than to buy the foreign currency in the spot market in the futures, in the spot market according to the future spot rate. The only source of loss to the holder is the option premium. The only source of gain to the option right, which is equal to the only source of gain to the option right. The holder has unlimited possibility of gain. The writer has unlimited possibility of loss. So the gain of the holder is the potential loss of the right. So it's a scenario where if one gains, the other loses, so to speak. And then a currency swap is a hybrid type of contract, which includes a spot sale of a currency with a clause for the forward repurchase of the same currency at an agreed rate. So swap transactions can be between private individuals or central banks of different countries. A case in point is a scenario in which the Bank of England credits 100 million pounds to the account of the ECB, the European Central Bank, and the latter credits 151.6 million euros to the account of the Bank of England, and agrees to retransfer with one another at the rate of £1 to 1.6 euros, which is €1.60 of euros. So the £1 for 1.6 euros, it's like a forward rate, which is agreed at the time when the counterparties enter into this transaction. The counterparties in this case are the central banks of England and the European Central Bank. The Central Bank of England is called the Bank of England. So with the swap transaction, it is a transaction in which two currencies are exchanged simultaneously on the spot and forward markets in the opposite direction. So in the spot market, a certain amount of currents will be moving in one direction, and then in the future, an equivalent amount in terms of the foreign currency has to move in the opposite direction. That's a swap transaction. So in the scenario that is given in the first bullet, the forward arrow, it's a scenario, it's a situation where the Bank of England is preferring or crediting 100 million pounds to the account of the ECB. And then the backward arrow, it's a scenario where the ECB is now crediting the account of the Bank of England with 151.6 million euros at a later date, and agrees to retransfer with one another at the rate of £1 for 1.6 euros, which is the forward rate. This is the forward exchange rate. Swap transactions are more important than forward transactions. They are second only to spot transactions, and they are organized by the International Swap Dealers Association. What are the uses of these swap transactions, especially between central banks, or even just between banks in general? They are used as a strategy of managing cash by multinational corporations. The parent company in the US, 3 months excess liquidity of dollars, and the subsidiary has a shortage of United States dollars but excess pounds. So they engage in a swap transaction in order to push in the subsidiary from the shortage of United States dollars, given the fact that the US dollar is a reserve currency, or a currency which is preferred in international trade. The second function, other than to provide cash or to manage cash, is to raise funds cheaply. The scenario which is given in the second bullet there, it's of a European company which wants Japanese yen, and the Japanese company which is not interested to invest in Europe or in the euro, but are eager to invest in the Chinese yuan. A Chinese company needs euros, but Europeans are not interested to invest in China or yuan. What is the solution or the way forward? So obviously, this scenario would require a swap transaction involving all these counterparties. We've got the European company, the Japanese company, the Chinese company. So we've got 3 counterparties: the European company, the Japanese company, and the Chinese company. We can work out the most suitable swap transaction as a homework in order to resolve the financial needs of these 3 companies. And then the third point is that swap transactions are used to manage currency portfolios of banks, especially big banks, like your central banks. Banks swap currencies to avoid currency mismatches. A scenario where you've got an excess of a currency which you don't need, you will be able to offload it in foreign exchange markets to those who actually need that currency, so that you don't have money lying around. Because as they say, money should not sleep, or money does not sleep. We have a scenario where SPI has $150 million excess of loans over deposits, but it has excess deposits of pounds. So a swap transaction in this case, would resolve this situation where there is an excess of deposits in terms of pounds. And when that situation is addressed, it will improve or rectify the liquidity position or the asset and liabilities mismatch for this entity called SPI. A swap includes two rates so that the swap rate is quoted as the difference between the spot and the forward rates. Swap versus futures. Mostly forwards and futures are for short periods of up to 1 year, but swaps can stretch between 5 and 20 years. So they tend to be long-term contracts. Futures have active secondary markets, but you can't have, or rather you don't have active secondary markets for swaps. Futures are standard contracts, whilst the swaps are tailor-made. Futures contracts are guaranteed by futures exchanges, but swaps, since they are not sold in standardized markets, but they are exchanged by counterparties who tailor-make them to their specific situations, the contract is not really guaranteed, by an exchange of some sort. It's only guaranteed by the agreement between the counterparties involved. In the meantime, if one of the counterparties goes bust or bankrupt, the others, they become exposed or they suffer losses. But nowadays, there's all sorts of risk management measures that are introduced to prevent exposure even to these derivative financial instruments. But if such deposit insurance schemes do not exist, whoever was involved in a swap with a company which experienced a bankruptcy, it means they suffer a loss or they experience the full exposure to the risk which they were trying to run away from as a result of the asset liability mismatch. The determination of exchange rate. We've got two approaches. The elasticities approach, which postulates that in the absence of government intervention, exchange rates are determined by the forces of Forex supply and Forex demand. A small shift of the supply of Forex may lead to a great depreciation of the exchange rate and vice versa. And then we've got the monetary approach, which is also called the purchasing power parity theorem, which states that the exchange rate between any two currencies or between any two economies is the rate that equalizes the domestic purchasing power of the two currencies. This implies that the exchange rate is equal to the ratio of the average price level in two countries and can be expressed as follows. The exchange rate will be ER, which is the exchange rate, plus PT, which is the domestic price level, plus PW, which is the foreign or the world price level. This is just a generic formula. In practice, the formula is normally expressed as a fraction of some sort. You can check that from the internet. This is just a generic expression to say we take into account the domestic inflation index and the foreign or the world inflation index in determining the exchange rate which will be prevailing when it comes to the purchasing power parity theorem. We know that addition can actually stand for multiplication. And when you are multiplying with a fraction, whatever was addition might be actually, a fraction in the final analysis. And then if 20 oranges cost the same in South Africa as in France, then the exchange rate is 1 rand is to 1 euro, provided here the only determinant is the only determinant of the exchange rate is the trading of these oranges. If the foreign price level increases by 60%, then the exchange rate becomes 1 rand is to 1.6 euros. It means the euro is depreciated. If the purchasing power parity theorem did not hold, what it simply means is that the French would import oranges from South Africa and sell them in France. And this would lead to the equalization of the exchange rates. Because as oranges are purchased from South Africa, they would become scarce, which would drive up their prices in rands, thereby causing the rand to depreciate. And in France, they will become cheaper, which will drive down their price until the two prices are equal at a certain point. It might not be necessarily 1.6 because the euro will be going down as more oranges are imported from South Africa and sold in France in euros, and less oranges exist in the South African market. So the equilibrium might be established at, say, 1.3 or 1.2 or any point. Yes. Because one currency will be appreciating, the other currency will be depreciating. In the Eurozone, the euro will be appreciating in value and the rand will be depreciating due to the scarcity of the oranges, which are being bought for arbitrage purposes in France. The criticisms of the purchasing power parity theorem is that it's very unrealistic and rarely applies in the real world because it assumes zero transport costs. We know that to transport oranges between France and South Africa, it costs a lot of money because it's thousands of kilometers. And then it's also difficult to isolate two identical bundles of oranges or any commodities for that matter in two different economies because the climates of France and South Africa are different. So even if you've got oranges, both in France and in South Africa, the oranges won't be necessarily of the same type. And this may imply that the purchasing power parity theorem does not actually apply because it assumes homogeneity of commodities. Some commodities cannot be bought for resale in other countries, such as direct services. You've got direct services such as haircuts, medical care, counseling, and so on, and teaching. You can't buy cheaper teaching in Zimbabwe and sell it in a country where teaching is expensive, or tuition rather. Learning or tuition is a direct service. As a customer, you can't buy it where it is cheaper and sell it where it is more expensive. And then when we are looking at exchange rate regimes, we've got 3 types of exchange rate regimes, which you can review from any elementary macroeconomics textbook. We've got the fixed exchange rate system, the flexible exchange rate system, and the managed or dirty float exchange rate system. With the fixed exchange rate system, the government has got absolute authority through monetary authorities to peg the exchange rate at a certain level vis-a-vis a currency or other currencies. This is done to address issues such as price instability. But in a world where economic events change rapidly in the real world, over time, this exchange rate causes the domestic currency to be grossly overvalued, which leads to a balance of payments deficit, characterized by a huge current account deficit or balance of trade deficit. At times, if the economy is doing well, the exchange rate may become undervalued. As is the case with China, there was quite a bit of time when the US was complaining that the Chinese yuan is grossly undervalued. In China, It's a communist country where things are fixed by government. Most macroeconomic fundamentals are fixed by government. So the Americans, they will say the Chinese, they deliberately keep the value of the Chinese yuan grossly undervalued so that they can push their exports, not only to the United States of America, but to other countries, to other economic regions such as the European Union and also Africa, in order to enjoy a balance of payment surplus over time at the expense of trading partners. This is what caused the United States economy to retaliate in terms of these tariffs, during the time when Donald Trump was president of the US. Under this framework, and then we've got the flexible exchange rate system, which is determined by Forex supply and Forex demand interacting freely with each other. There's absolutely no government interference in exchange rate determination. The exchange rate varies on a daily basis whenever the foreign exchange markets are operational. There is no economy with such an exchange rate system, even though, because approximations of this regime exist in Western countries. And then what we have is what normally prevails in most economies, which is some kind of hybrid system where there is an upper and a lower bound or limit within the foreign exchange market. The exchange rate is not allowed to breach the floor or to overshoot the ceiling. So the government intervenes when the exchange rate depreciates to such a low level that it's experiencing exchange rate overshooting. They show up the domestic currency by selling Forex, thereby making the domestic currency more scarce or scarcer, and making the foreign currency freely available. I believe that's what they did in China. I mean, not in China. That's what they did in Russia recently after the invasion of Ukraine, in order to prevent the free fall of the Russian ruble. You can check that. You can fact check that. But in a dirty float or managed float exchange rate regime, there is an upper and a lower limit. So if the currency is firming too much, strengthening too much and hurting exports, the government will buy Forex, thereby making the domestic currency freely available, or domestic currency denominated financial instrument. And this would cause the domestic currency to depreciate, thereby, causing the situation in foreign exchange markets to be more favorable to exporters, to drive exports, and thus benefit the domestic economy in terms of the capacity to earn Forex. So we are done with this brief overview of foreign currency exchange market dynamics, or foreign exchange market dynamics. So what is left for me to do is to do this demonstration. It is to do this demonstration of calculating the forward premium and the forward discount, which I will do in a separate video tomorrow, the 30th of March 2022. Thank you so much for listening in. I appreciate your taking time going through this video. Remember to subscribe to my channel and to share this video with your colleagues.